Welcome to the January 23rd episode of the Energy Show. I'm energy journalist Markham. Now, today we're going to be talking about what else are we going to talk about? We're going to talk about Donald Trump and his energy plans. Before we, and I'm going to be talking with Chris Battaille, who is an energy economist and modeler, and I've interviewed him many times before, and I really appreciate his global perspective, his international perspective, because you don't get that often with Canadian experts. Welcome to the show, Chris.
Nice to be here, Markham.
Before we get going, I'm just got a couple of little housekeeping matters here. We would like to get your emails, get feedback and questions you might have, comments that you may have. Keep them clean now. You can do that at theenergyshow@gmail.com, and energy is with an I, not a Y. Or you can text at 587-330-5757. And I want to give a quick shout out to Rory Johnson, the oil economist who writes the excellent Commodity Context newsletter. I used it to prep for today's interview, and you can check it out at commoditycontext.com. Okay, Chris, it seems like this week has been Donald Trump all day, all the time, because the changes that he is saying that he's going to make to the North American energy system are really quite substantial. So maybe just give me kind of your general take on what Trump's up to.
Yeah, so Trump has issued a whole bunch of executive orders on a bunch of different topics from the moment he took the presidency. Several of these are on energy and have to do with energy-related subjects. But the keystone under all this is energy dominance strategy. He wants the U.S. to be producing so much oil that it has a lot of leverage over global oil markets, as it did, sort of prior to the 60s and 70s. The U.S. is already, the interesting thing though is the U.S. is already at the highest levels of oil production it's ever hit. It's moving from frac field to frac field really rapidly, and I personally don't see how they're going to be able to raise production all that quickly or all that much. But at the same time, he's also gone and gutted a lot of other support for EVs, EV charging. He's stopped payment of the IRA provisions with all their supports to the energy transition. So there's a lot we could talk about, but the core thing is that energy dominance strategy and focus on fossil fuel production.
Right. The subject of today's interview is actually the 25% tariffs that Trump has promised to impose on Canada and Mexico on the 1st of February, just coming up in about a little over a week. And so 25% on Canadian oil and gas exports into the US. And he has said very clearly they are not exempted. They are going to be
Yep.
tariffed as just like all of any other good that comes across the border. And that has all sorts of implications. It has implications inside the American system. It has implications for Canadian producers. So let's start with inside with the American system, and this is where Rory's information was really helpful. And he talked about how prior to the 1990s, and I guess we go back really to the 70s, when we had the two energy crises, and there was a lot of concern about peak supply, right? We just weren't going to have enough oil. And that's when they began to develop the oil sands and other unconventional sources. And the American refineries began to pivot to process, to refine that heavier crude. Have I got that right?
Mhm. Yeah, no, that's exactly it. You have all this heavy crude that was potentially available in Canada. There wasn't a lot of use for it here. There wasn't a lot of outlet for it one way or the other. But you had all these Gulf Coast refineries that could expensively rekit at that, mind you, to absorb that heavy crude or mixes of heavy crude coming from Canada. And you had a whole system of extra pipe that was put in various sequences to get it from Alberta down to the U.S. South Coast, and through the Midwest, which is actually key, and then down to the South Coast.
Right, because the majority of the heavy crude is actually processed in the Midwest, around
Yes.
in the Chicago area. And the fact that they had to, when you say rekit, what you mean is they're installing equipment like cokers that will
Yep.
allow them to process the ultra heavy sour crude that Alberta produces. And the
Yeah.
assumption was that over time, that oil would get heavier and it would get more sour, meaning it had more a higher sulfur content in it.
Yeah, and so you had all these refineries. Those refineries have to do two things. They have to reduce the carbon level, which is the black, but they also have to add the hydrogen level, which is the lighter component, to make it back into something more like a lighter crude, more suitable for gasoline, aviation fuel, and petrochemical feedstocks. Now, what's interesting is that strategy got hit sideways by the whole fracking revolution, because most of the oil that comes up from the frack wells is quite light and high quality, and it's sweet. It's not sour. So that stuff tends to end up that is competing with that very sour, heavy Canadian crude. Now they've made it work, and they tend to export a lot of that lighter stuff. And the gas that comes up with that frack crude is actually made gas very cheap across North America. But they do have this sorting problem of what to do with the heavy crudes and the light crudes.
Yeah, now where I'm going with this, Chris, is Trump has accused Canada of ripping it off, of taking advantage of those poor innocent Americans who never saw this coming, and the rapacious Canadians went in there, and boy, we're ripping them off. But that is exactly not, it was the exact opposite that happened. The evolution of the system we're talking about was undertaken very deliberately. This was done by the American refining industry. It was done the Canadian oil companies, and actually early on it was mostly American oil companies that were undertaking getting into the oil sands. And they set up this system of shipping diluted bitumen down into the Midwest, down into the U.S. Gulf Coast, and that system has grown up over the course of well maybe at least 40 years and maybe a little bit more. So this is not a case of the nasty Canadians being mean to the innocent Americans. This is the industry, this is the system, the structure that the industry itself created.
That's exactly right. And also, because there was so much oil coming at such a cheap cost out of the Canadian oil sands, typically it was sold at a rough discount. So to somewhere between 10 and 30% discount on an energy and sort of content level basis with the lighter American crude, which was part of the reason why they wanted to build TMX out to Vancouver and move more to Asia, just to even up the what they call the Hardesty discount.
Right. And I find it ironic that, even though the Canadian industry was quite happy to cooperate with the American industry in setting up this system, eventually it didn't work. Eventually the discount you talk about, the differential as it's referred to in Alberta, and which historically has been between $9 and $15 a barrel, based on West Texas Intermediate. So it's heavily discounted oil to begin with. And it worked for a long time until it didn't. And then the differentials began to widen over the last 15, 20 years. And there was a lot more demand to go to the East Coast or the West Coast to get into Asian markets, maybe European markets. And it didn't work out that well. Trans Mountain Expansion is the only oil pipeline that's got to the West Coast. It's 525,000 barrels a day of capacity. But
It's
nevertheless,
900 now.
oh, but that's with the existing Trans Mountain pipe. The Trans
Oh
Mountain
yeah, yeah, that's right.
expansion is 520. So my point here is that the industry set the system up and then has wanted to change it because it was disadvantageous for the Canadians, and all of that is great, but that doesn't justify those tariffs.
To be honest, the tariffs don't make a lot of sense, for a lot of different reasons. First of all, about 60% of the crude the U.S. imports is from Canada, and 24 to 25% of the refined petroleum products they make are from Canada. Now, and what happens at the border when that crude enters, the way the rules work is whoever owns the oil when it passes over the border pays the tariff. Now, by most of these contracts are written today. Now, obviously, they'll get rewritten through time, and the spot markets will change. Is that typically by the time once it passes into the U.S., it's owned by Marathon. It's owned by a big U.S. refiner. So what's going to happen initially is mainly this is going to be U.S. refiners probably paying that tariff and then going looking for cost recovery in the rest of the U.S. somewhere else. And obviously, with that huge increase in cost, they'll go looking for substitutes really fast. They'll try to reduce demand, but for a brief moment, it's going to be U.S. refiners paying the tariff, and then U.S. consumers paying the cost somehow.
So there's been some speculation about how that would be applied and who would actually pay it. And is there any chance that the refiners can get the producers in Canada to pay some or all of the tariff? And
It
reduce.
completely depends on the contract that was written.
Gotcha. Okay, it depends on the contract, so we don't know how much that is. Oh,
We don't know. We don't know
we
how
have
those
no way of
contracts were
knowing.
written. Yeah.
What about the spot market? Because not all of the crude is contracted.
Yeah, I don't know how. Yeah, Rory's the guy to go and ask about how much of it's spot and how much of it's contracted and how long it's contracted.
Gotcha. So there's a lot of unknowns here. There's a lot of uncertainty. But one of the points that Rory did make was that the American refineries will not be able to switch to light sweet crude, light tight oil, as it's called
No.
from shale. And this seems to be. We floated a little hypothesis early this week on this show, and we can do that because it's so things are so up in the air that your guess is as good as mine. But the hypothesis is that if Trump is looking around, he wants energy dominance, and he wants a made in America first and foremost. One of the things he can do is take market share away from other countries that are exporting into the United States. So if you're looking at assuming that the American production could be increased, and that's a big open question. But if you could, then why not? If you reduced imports of Canadian crude by say 2 million barrels, there's 2 million barrels of market share for American producers. I don't know. Is that are we stretching a little bit here?
Well, there's all sorts of physical logistics that go against that. It depends on the capacity. Like, if it's for American domestic consumption, it's got to be refined, right? And the refineries are set up to bring in a certain mix at a given time, and it's not an easy thing to flip between crudes unless they're designed to do that. It's going to take time and a lot of money, right? So for domestic consumption, it's highly rigid. Now, on the other hand, if somehow the U.S. could raise, production 2 million barrels a day from somewhere, that's possible. But the system's not. You need the shipping in place. You need the ports. You need customers. You need the whole thing. Like, you've got we're captive exporters to the U.S. to a large degree, and you're going to tax us and try to reduce our production, which is simply going to rebound on the U.S. system. Now, several people have pointed out the only other source of heavy crude is Venezuela. So Venezuela are parts of or some of the Mayan crudes. And so you're going to flip for Venezuelan crude or emulsion in the place of Canadian bitumen.
Well, and the irony here is that I think it was just today, Trump said that he's considering barring any import of Venezuelan crude. How does one make sense of this? Yeah. Okay, so let's talk about if, in fact, the refineries decided that they would run light sweet crude.
Yeah.
Uh, Again, getting back to the point that Rory made, is that then cuts down the range of products that they can actually make out of a barrel.
Not necessarily. It totally depends on the refinery setup, right? Like, if say you had an old light refinery and you kept it maintained, but you added the components you needed to do hydrogenation and coking and cracking and what have you, and you kept the routing inside the refinery, you might have the capacity to flip. And light crude is just better than heavy crude, for making products. It's easier. It's closer to final gasoline, aviation fuel, and everything else than heavy crudes are, and you don't have to deal with the sulfur, right? So, if you've still got those refinery components that can handle the light, you're okay. But My guess is if you're running a refinery that's moving 90% or almost entirely Canadian crude for years, you probably haven't done the maintenance on your lighter sections. You haven't maintained you, or you're not set up to simply just swap it in and shut off parts of your hydrogenation equipment and your cracking and what have you. Now, that's a question to pose to those individual refineries, and every refinery is this individual beast. They're very, very different. They're very bespoke. They're like, they're not something that comes out of a factory, right? So it's going to be very specific. I have a feeling very few people actually know what would happen if, a million or two barrels of Canadian crude got cut off from the US market.
Fair point. And I guess the point, maybe I didn't describe what Rory's argument was. I think simply he said that if you have light sweet crude, you're going to have a much higher percentage of the lighter distillation cuts like naphtha and
Yeah.
liquefied petroleum gas, and then some of the lower cuts, which I assume would be like diesel and bunker fuel and that stuff. You'd have much less of that. Well, then there are markets for those fuels. So where do you get those fuels from?
Yeah. Well, okay, so this is the thing. Heavies and lights are kind of like this. The valuable stuff's all up in here, and the heavies are kind of down here. The junk is the pet coke at the bottom, like the heavy, the asphaltenes and what have you, right? And I, to a certain extent, light is better. It's light is easier to use and what have you, but it comes in a certain mixture. And the key point thing to think about here is refineries generally set up to accept a certain type of crude with all its characteristics, and then in a certain order they do vacuum distillation, cracking, hydrogenation, and then refining to and reassembly to final product. Right. So it's like doing Lego with chemistry. It's not super flexible.
Okay, so the bottom line here is somebody's going to pay.
Yeah.
And
Yes, somebody will pay.
somebody's going to pay. And I think the prevailing sentiment is that higher costs for U.S. consumers. Now, this is really interesting. I had Professor Kristen van de Biesenbos, who's an energy law prof, on yesterday, and we were talking about the price of energy in the United States, and the average cost for a gallon of gas right now is like $3,
Hmm.
$3.10, which is I think even on the low end in recent years. So
Yeah.
gas isn't expensive. Other parts of energy, like natural gas, is
Is
low,
extremely cheap.
it's extremely cheap. Electricity in some parts of the country is a little expensive. Like in San Diego, they think they pay 40, 50 cents a kilowatt hour. That's pretty expensive. Uh,
Hmm.
but for the most part, energy is pretty cheap. So any increase in the price of a gallon of gas is politically sensitive. And this
People
strat,
see it.
yeah,
Yeah.
exactly. And this strategy seems almost designed to raise the price of a gallon of gas, which Trump has promised to lower. And I don't know what it seems that would, cause him political problems.
We're in Wonderland. We remember what happened the last time around, and strange and wonderful, not so wonderful political things tend to happen. And who gets blamed for those gas prices? Who knows, to be honest.
Now, what about lower profits for U.S. refiners and Canadian exporters? I'm particularly interested on the Canadian side
Yep.
because over the last decade, the returns from the oil and gas sector have actually not been very good. They've been kind of underwhelming, and
Yep.
investors late now are demanding a lot of their free cash flow back for higher dividends and share buybacks. And in fact, I remember a couple of years ago, I saw in the investor presentations, it was 75% of free cash flow. Now I'm being told that it's like 75 to 100%.
Oh
Investors
wow. Okay.
yeah, they're even more demanding. And lower profits are not going to be looked upon well if in Canada by investors.
Yeah, and that's a question is who owns all that stock? Like who's got the biggest investments? And from what I understand, and this would be something to check up on and maybe do a little research and talk to somebody about, but it's how exposed are the Canadian banks and financial institutions to the very large oil sands companies? Because I know their exposure has gone up quite a bit. Like as there was a foreign exit of investment, a lot of the Canadian pension funds and banks and what have you piled in. And if the returns on capital start falling rapidly and there's not as much free cash flow, that's going to feed right back into the Canadian macroeconomy.
What about the profits of U.S. refiners? Because I was reading just this morning that the margins for refineries have dropped over the last year or so quite
Mm-hmm.
significantly. And they're being squeezed. And some refineries are being shut down. They're being shifted over to biodiesel or some other kind of product. And and then they're staring down the prospect of peak oil demand. We've already had peak gasoline demand in the US since something like 2017, I think. And so there's hasn't been the prospect of a lot of growth in the American market. The only export market would really be the only thing. And this has got to make US refiners very nervous.
Yeah, no, and to be honest, the business of refining has not been terribly profitable for a couple generations. And for that reason, not a lot of plants were built. And what was there was rebuilt to handle heavy Canadian crudes and what have you. The profitable side of that business is chemicals, is all sorts of chemicals manufacturing, plastics. But what that's been generally doing is using natural gas liquids and what have you, and the really light cuts in transforming those into chemicals. That's the side. That's where the demand side is increasing. Whereas the refiners they're in tighter and tighter walls, where lower and lower roofs to operate in.
Well, okay, so that doesn't sound very good. Now, one of the things I know you travel and you go to conferences, around the world. I know because I ask you for interviews and you're off in Europe or Asia someplace. So, what are people saying about the energy transition and the prospect of impending peak oil demand? Because it's almost like there are two worlds out there, and they never touch. On the one hand, there's the Trump world and the Danielle Smith world, the Premier
Yeah.
Alberta Premier Danielle Smith, who believe in the OPEC fantasy, frankly, from my point of view, of going from 103 million barrels a day today to 120 by 2050, like expanding 17 million barrels a day of extra consumption. And
Hmm.
so they talk about, doubling oil production in Alberta, those kinds of things. And then I see story after story and interview after interview where we're talking about peak oil demand in China in 2025. We're talking about road transport peak oil demand, which is 45% of total global oil demand. I mean, there are all kinds of signs in the system all over the place that demand growth is slowing and
Yeah.
looks like it's not going to pick up again. And so, what are people saying when you have these conversations?
I think it's interesting. I think the big disconnect in those conversations, besides the wanting to have a certain future versus another, is I don't think we can argue with the fact that the demand for transport services and for plastics and chemical feedstocks is rising globally. Like, there are generally good macroeconomic conditions. Even with China on the back end of its big growth spurt, with India rising and all sorts of other, a lot of African nations are hitting a takeoff point with industry. So the demand for transport is there, the demand for chemicals is there. But the thing is, it's if you think that previous transport demand is going to be as crude oil intense as in the past, yeah, sure, 125 million barrels a day. But if you think that the demand for transport is going to be met other ways, and specifically with all of the margin plus with electricity, and then more and more with electricity through time, the fundamentals for crude oil aren't there. And it's whether or not you understand and sort of understand that difference. It's the crude oil intensity of transport demand.
Yeah, you and I have talked about this before, and we've talked about specifically about the various modeling exercises. You know, you have the OPEC. OPEC's not alone. I mean, ExxonMobil and Shell and other, ironically, oil companies who are modeling oil demand increasing. But boy, there's sure a lot of, I think, very credible modeling, and Rystad
Yeah,
would be one, S&P Global, who really see the drop off as the transportation sector electrifies, and it's not just cars and trucks. We're
yeah.
starting to see medium duty. We're starting to see two and three wheelers, which is huge in Asia. Buses, the transit system, on and on and on. So the transportation sector itself is electrifying, and that's not going to stop. And the argument, the modeling that I look at, essentially the rise in petrochemical and aviation demand doesn't keep up to the drop in road transport demand caused by electrification. And
Yeah,
that's
no,
why the
I think that in the essence is about right. If you look, like IEA has been demonized for the last few years for having such a low demand forecast for crude oil, right? And with OPEC notably differentiating from them, but very recently OPEC's come a lot closer to where IEA is. And if you actually look at investment behavior amongst the ex North American producers, like Saudi Aramco is most of its new investments going into petrochemicals. It's going into side products for crude oil and gas and what have you. It's not going into crude oil exports for transport or they see the writing on the wall, and they have this huge reserve base. They want to monetize it. So they're moving it to other things that can produce value added for them.
Yeah, that makes perfect sense to me. It is highly ironic that the Saudis are installing huge amounts of solar and hydrogen.
Yeah,
You know,
exactly.
and that's not unusual. I mean, we see other oil exporting countries like Norway, who are also keep maintaining their oil production, but also moving into wind or increased hydro, or whatever it happens to be, electric vehicles in the case of Norway. So
Yep.
the reason I asked you these questions, Chris, is because we always need to be mindful of this larger global context in which the global energy system is being transformed far more rapidly than we expected, a decade ago. And that sort of hangs over the policy decisions that President Trump makes. And so what we've talked about earlier about choices that are made and what will the refineries do and all of that then has to be overlaid on top of these bigger changes that are taking place in terms of the energy transition.
Yes, no, absolutely. And the interesting thing too is to keep in mind that it's one oil and gas system, basically from the Northwest Territories down to Veracruz in Mexico, right? It's all the same system of varying types of crudes, all linked together, all being processed one, and that whole animal kind of needs to move in sync with demand, both domestic demand and the net export demand for that product. Now, right now, you've got several very different visions for that future, and because there's several different very different visions, the investment profile is just all over the map. There's no coherence whatsoever.
It sounds like a Trump energy policy.
Yes.
Incoherent and chaotic.
Yes.
Well, look, Chris, thank you very much for this. This has been a very useful conversation. I think we understand the structure of the North American oil and gas, at least particularly oil system, and where it's going to go, and how. I guess we're just going to have to wait to see how this plays out. And so I'll probably talk to you in maybe February, late February, or sometime in March, to see if Trump actually followed through with his threat to
Yeah.
impose the tariffs and how the industry is adapting to those tariffs if in fact he does.
As if we didn't have enough to talk about before, Markham.
Indeed, indeed. Well, he's making work for me. I will never be out of work as long as Donald Trump is president of the United States. Chris,
Yeah, excellent. Thank you.
yeah, thanks a lot. Appreciate this.
Okay, you take care.